I would like to welcome you all to this Global Finance Seminar on behalf of co-organizers, Hong Kong UST-NYU Stern Master of Science in Global Finance Program, South China Morning Post, and CFA Institute. Before we start, please be reminded to turn off your cell phone or set it to vibrate mode. Kindly note that there is an evaluation form in your folder. Please fill it up and return to the registration desk before you leave. Your feedback will allow us to offer a better event in the future. Thank you for your help. Our keynote speaker for tonight is Mr. Sean Craig, IMF Resident Representative in Hong Kong. He will talk about challenges for Asia finance in the wake of the Euro area crisis. A panel discussion will follow Mr. Craig's talk. Without further ado, let's all welcome Mr. Craig Song.
Thank you very much. I'm very pleased to be here to talk to you about some of the work that we've been doing at the IMF for our Global Financial Stability Report, which is a publication on our website. I work here in the Hong Kong office, but I contribute to this report. In particular, I contribute to the work on Asia. So what you will find when you look through the report is that much of our work is on Europe and about the crisis in Europe. But much of what I do is look at the impact and the spillovers into Asia of the crisis in Europe. So my talk will first set the stage to go over the situation in Europe and the impact that is having on the banking systems, the financial system in Europe, and then how that spills over into Asia. And then the challenges that poses, both for Asian financial institutions and also for the authorities in the region. And the basic challenge faced by Asia comes from its heavy dependence on the US dollar. So much of finance in Asia has been intermediated by global banks, US banks, European banks in dollars. This is trade finance, supply chain finance, project finance. All the range of international financial activities in the region is done in dollars. And this is being taken over to some extent by Asian banks, opening up new dimensions of risk facing these institutions and new policy challenges. And so this is really the basic theme of my presentation. And what I'd like to do is go through my talk, starting with Europe and then transitioning to Asia. So now, just so I know, how many of you are students, graduate students connected to the university? If you could just please raise your hand. Okay, thank you. So that's very good. I mean, we have a panel here, and we're here to answer questions. We have a very able moderator who will also intermediate your questions. And so I hope after the presentation, we'll have a chance for a very active dialogue and discussion on many of these issues that come up now. So before I start my talk, I'd also like to thank the organizers, CFA and South China Morning Post, and of course the university and the graduate programs for inviting me here and giving me a chance to share our work at the IMF with you today. So it's really, the subject is challenges for Asia finance in the wake of the Euro area crisis. And so just let's start by looking at risk in Europe as measured by the sovereign risk premium of Italy and Spain. And this is a spread of government bond yields, 2-year yields over German bunds. And you can see what is essentially a roller coaster, with spreads rising very rapidly starting in the second half of 2011, falling sharply as with the first European Central Bank intervention, the long-term refinancing operation that bought stability and bought time for Europe. But then, starting again in the spring of 2012, spreads began to rise rapidly again, especially spreads for Spain, which in turn led to another rescue operation, the outright market transactions. The first operation, the long-term refinancing, was really the provision of liquidity to banks, equivalent of well over €1 trillion to European banks. The second operation was a commitment by the European Central Bank to purchase bonds of sovereigns like Spain, like Portugal, that could not sell their debt on the bond market. And these rescue operations essentially brought stability to capital markets in Europe, in the sense that it broke this negative feedback loop where concerns about the banking system were feeding into the sovereign, and raising another round of concerns where the implicit guarantee that the sovereign provides to the banking system was raising concerns that sovereign debt would be boosted by this negative feedback loop. And really, the way to think about the problem in Europe is really as a debt problem, where in the first decade of Europe, rapid credit growth led to a buildup of debt, not only sovereign debt, but private debt. And it's important to realize that. You had, in particular, in countries like Spain, Portugal, with the very low interest rates brought about by the creation of the euro. And you saw large transfers of funding and credit from the center of Europe to the periphery, as German banks, French banks lent large amounts of money to individuals in Spain, fueling the real estate bubble that has now collapsed in Spain. And this buildup of private debt and this buildup of problem assets on the balance sheets of Spanish banks and Greek banks and Portuguese banks generated this concern about the stability and the sustainability of sovereign debt. And in particular, you can see, if you compare the countries in the periphery to countries in Asia or countries in Central Europe, you can see that both from the perspective of external debt and from the perspective of their net international investment position, the European periphery countries are in a very weak and precarious situation. They have what we call a very large negative net international investment position, right, which is a reflection of the net borrowing that these countries have done vis-a-vis the rest of the world. Right? And this comes about through financial transfers from Germany and other parts of Europe through the banking system to these countries, at the same time as these countries built up very high levels of gross debt. Right? And this is really the fundamental source of the problem of these countries. Growing indebtedness together with a large external debt position that was reflected in large current account imbalances in these countries. And you can see that in particular here when you can see the consequence of this, where they continue to borrow up to the point where there was a sudden stop, where the borrowing by these countries stopped because all of a sudden the creditors realized that they were facing much higher credit risk than they realized and stopped lending. And at that point, the European Central Bank had to step in. And you got an offsetting transfer of funding from the European Central Bank to the regions through this financing by the European Central Bank of the banking systems in this region. And you can see this very clearly in this graph, which shows you how public credit, public funding has substituted for private funding in the banking systems of these countries, right? And so the European Central Bank, together with the European Securities Market Program, that's SMP, and the funding provided to the banks by the European Financial Stability Mechanism, really replaced funding from the private sector. And essentially, without this funding coming from the European Central Bank, you would have had a banking crisis in Europe, because you really had a loss of access to wholesale market liquidity by the banking systems in the European periphery. And the European Central Bank had to step in, providing central bank funding in place of the lost private wholesale funding. Now, we could spend a whole lecture and several lectures on just this issue, but let's move on to look at what else was going on driving this European crisis. In particular, we had a disappearance of the investor base for sovereign bonds in Europe, in the European periphery. And what this shows you is how portfolio investment flows evaporated from Greece, Ireland, Italy, Spain, and Portugal, and flowed to France and Germany in particular. So what you had is really the portfolio investors leaving government bonds issued by Spain, Italy, Portugal, and buying German debt, buying French debt. And so what you had was a blowout of spreads in Spain and Italy, and a sharp fall in spreads in countries like Germany, which became seen as the safe haven currency of the euro area. And one of the reasons why the euro didn't weaken during this period is because of this transfer of wealth from the periphery to the center of Europe.